Hi everyone, welcome to my channel. I'm Doris. I'm here to show you about my stock account and today's market update. Today the net asset of my account is 70,421.37. Today's gain is 0.13%. And today Apple has closed down 0.35%. SQQQ closed down 1.64%, and SPY closed up 0.11%. United Natural Gas closed up 4.67%. And let's take a look at the market today. Nasdaq closed up 0.36%, S&P 500 closed up 0.08%, and Dow Jones closed down 0.26%. Today, as I've been talking about yesterday, that the natural gas has been fluctuating recently due to the restraint of the winter and the high seasonal demand. And today, it's also been happening, the primary caucuses happening in Iowa, and let's take a look at how well the U.S. election affects the U.S. stock market specifically. First of all, historically, since 1952, the return of S&P 500 has averaged 7% in the election year, well below the average of 17% in the year before the election. However, since 1952, S&P 500 has not fallen in election years, with an average annual gain of 12.2% in the year of presidential re-election. Piper Sandler, Chief Market Technical Analyst Boris Johnson, told China Business News that U.S. stock market is expected to be in a high-level trading range this year. Specifically, it will perform well in the first quarter, being sold in the second and third, and then rise again for the fourth quarter after the election. The bank expects the S&P 500 to target a range of around 50-50. How does it affect the U.S. economy specifically? Is that election years typically stimulates the economy and avoids a possible recession. However, despite the positive impact, the election will weigh on the recent growth, with individuals, businesses delaying large purchases and investments due to political uncertainty, according to the latest analysis. At the same time, Wells Fargo, based on gross domestic product, personal consumption spending, labor market, private domestic investments, and commercial fixed investment, 5 macroeconomic variables through 1948 to 2016, during the difference between growth rate and the previous year, and found that no evidence that election year affects the economic activity. In addition, Wells Fargo believes that the increase in actual government spending in election years is no different from non-election years, and that while the growth in consumer spending and investment spending is likely to be strengthened during the election year, it is not supported by a clear policy based on economic impact of the pandemic. The bank did not consider 2020. Wells Fargo expects the U.S. economy to continue but expand slowly in 2024 from the restrictive stance of current monetary policy, while believing that this year's election will not have a material impact on the economy. In addition, UBS has said that while most U.S. elections will not substantially change the macroeconomic environment, different election results will have different consequences for the capital markets after the election. For example, when Trump was elected in 2016, he passed out a tax cut that have benefited the profit margin for most of companies, which have helped them to make more profit. At the same time, the macroeconomic performance will also be used as a forecast indicator of the election results. There is a market view that the state of the economy will affect the outcome of this year's presidential election, because the economy is an important factor for voters. According to the model made by a Yale professor, current economic growth and low unemployment are expected to make the ruling Democratic Party win elections. But inflation also gives Republicans a chance. If key economic factors change, the outcome could change decisively. Fair argued that the economy creates an atmosphere for elections to which candidates and parties must adapt. The preliminary fourth quarter GDP figures and the December PCE data on Thursday and Friday will be released. The Atlanta Fed's GDP now model is expected to grow by 2.4%, while the market expects core PCE growth to fall to or below 3%. With U.S. inflation not falling yet to the Fed's target, there is a market view that the Fed's existing decision could change the election outcome, because the sooner the Fed cut interest rates, the more likely the economy will grow before the election. In the first 3 months of the election year, rising economic growth usually favors the incumbent president's party, according to Fair's model, given the current inflation levels. If the Fed fails to cut interest rates before the summer, it may be less likely to decide the second half of the year, which could be labeled as partisanship. Back to the earlier point, the Fed's likelihood of cutting interest rates is still very low in the first quarter of this year. According to the recent hawkish speeches that the Fed officials have made, it is more likely that they will keep a more cautious eye on the security of low inflation. This is all I have for today. Thank you for listening. Don't forget to subscribe and see you next episode.